Welcome to Poor Millionaires. Today's guest is Simon Popple. Simon is a long-time gold advocate and proprietor of the Gold Programme, which is a website dedicated to helping investors build their exposure to the gold sector. We'll be talking about the current opportunities in the sector and how to approach the gold miners in particular. Poor Millionaires is a show for people with investable wealth of $1 to $20 million. We strive to educate, connect and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Simon Popple, welcome to the Poor Millionaires podcast.
Great to be here.
So we're going to have a talk about gold and gold miners later on the show, but I think first we better introduce you to our audience. So you're very much involved in educating people about how to go about implementing a strategy for investing in gold mining companies. But you didn't actually start off in that area, did you? You started off in, I think it was property?
I started off with doing an MBA, worked in the city, and then went into property. And I was the youngest director of one of the world's largest private property companies. And that was great, but I kind of left the market because I thought there was great potential with commodities, in particular gold. I probably left the property market 10 years too early, but people thought I was crazy when I did, and they didn't really understand what my thoughts were on gold. And we've now managed to so gold has finally taken off, but it's been a very long runway, but we finally got there.
So what sort of sparked the interest in gold initially then?
Well,
it was a sector from the property market as you could possibly get, I guess.
Yeah, no, exactly. Well, it's interesting because gold is really everything that property isn't. Gold is very liquid, it's very global, but it doesn't give you an income, and you can't leverage it conventionally like you can with property. Obviously, you can buy property companies that have got leverage, but it's a slightly different beast. But one of the things I like about it is the liquidity, the global nature of it, and at the end of the day, you can't print it, and so I think it's an asset that is not only going up in value, but I think it's going to go up a lot more in value. And even though people use phrases like they've been as good as gold, I'm looking forward to my golden years, I don't want them to marry a gold digger, I want to win that gold medal. You actually ask people, do you have any gold? They're like, no, I don't. And so it's kind of like, it's a new asset class for a lot of people. Yes. And that's what I do with the gold program. I kind of teach people how to invest in the sector.
Okay, so can you frame the current macro picture for gold then? Because obviously we're seeing gold increase in price pretty dramatically over the past year or so. What is actually going on in the gold market, and more broadly, because it's kind of seems to me that it's reflecting a kind of heightened uncertainty about the state of the world and what's going on with the global financial system and the monetary system. So how would you characterize the current situation with regard to gold?
Well, I'm often asked, what's driving the gold price? And just like you've asked me there, and I think there's really four things. I refer to them as MIDI because I don't have a great memory. I find MIDI is quite a useful way of remembering them. But basically, MIDI stands for market uncertainty, where all the points you just raised. And I think the only thing I'd add to that is the gold price a lot it tends to depend on what happens in the US. So if you've got market uncertainty and the points I'm about to raise in the US, then I think it's an even bigger driver for the gold price. But you've got interest rates, you've got debt, and you've got inflation, and that's your MIDI. And just dealing with them very quickly individually, a market uncertainty, huge market uncertainty. Add to that, you've got tariffs. Add to that, you've got the government shutdown. You've got the fact the Republicans really hate the Democrats and vice versa. Um, so I think there's plenty of market uncertainty in the world. You've then got interest rates, and lower is better for gold, and there's definitely a trend for them to come down rather than go up. Debt, eye-watering levels of debt, not just in the US but throughout the world, and I think that's causing a lot of concerns to not just the general population, but central banks and people like that, because you've got to service your debt, and if you service your debt, then as the debt goes up, the cost of servicing it goes up, and you've then got less money to spend on your population, so services and things like that, and then you've got inflation, and although gold is viewed as a hedge against inflation, that's not strictly speaking true, because there are times when the gold price will go down and inflation goes up, because the gold price goes up and down, inflation only goes up. But I think those four things: market uncertainty, interest rates and debt, and inflation, they're the kind of like key drivers of the gold price. And until one of those is, let's say, resolved, for want of a better term, I think the gold price is likely to go higher rather than lower.
So it's almost like we're in a perfect storm for gold at the moment, I guess.
Yeah, I think we are. And I think add to the fact it's a global currency, and we seem to have got a global problem. It's not just the US with high levels of debt. There's high levels of debt around the world. So I think it is a bit of a perfect storm, and therefore, gold is particularly attractive for people at the moment.
Mm. We've also seen a lot of central bank buying of gold, especially in the BRICS countries and sort of other kind of like emerging countries. And that's all part and parcel of a sort of a de-dollarization narrative, isn't it? And how does that all feed into the picture for gold?
Well, I think it feeds in several ways. I think one is it reduces confidence in fiat currencies, because if you've got your central bank buying lots of gold and countries buying gold, and they're buying that rather than your government bonds or treasuries, whatever they are, there's a kind of a willingness to have gold rather than your currency, which I think is a bit of a head scratch for people. And I think that central banks have recently switched from being predominantly dollar treasury based to gold based. I think it's only very small. I'm not sure if it's all central banks, but that's certainly the direction of travel. And if banks are buying gold, then that's a bit like, I don't know, the headmaster saying this is what you should do, and you kind of do it. And it's difficult for a central bank to say, right, we're going to buy gold, but you should buy bonds. People tend to buy what people senior to them are buying, or leaders are buying.
Yeah.
And so I think that with this move of central banks buying gold, I think the population is largely following their behaviour and going, well, do they know something that we don't? Perhaps we should be buying gold as well. And obviously that increases demand. You've got limited supply. What happens? The price goes up.
So if I'm an investor, I'm looking to sort of get a piece of this action in the gold market. I mean, I've got obvious choices in front of me. I can buy physical gold, which, I mean, some people, like the idea of having the sort of wealth in the hands. They can touch it and feel it, but then other people are kind of like, well, I don't really like the risk of holding that in my house or wherever it may be. And then the other options are things like ETFs, where you can kind of hold the physical gold, but the ETF sort of looks after that for you. Companies like Bullion Vault and things where they hold the gold. And then you've got the gold equities market, so the gold mining companies. And I guess this is the way where you can really kind of turbocharge the returns of gold, can't you? Because they've got the they've got the leverage into the gold price.
That's very
So,
true. Yeah.
so just give us a bit of an overview about the gold mining sector and how you originally kind of started to look at that as an investment asset class, and just give us an overview of the main things that people need to bear in mind about this sector.
No, sure. Well, first of all, just quickly going back to physical gold, you don't need to take delivery of it. You can get it stored and insured professionally. And that's a massive misconception people have. They think, if I'm going to buy gold, where am I going to stick it in the house? The answer is, I've bought a lot of gold, never seen any of it, because I get it stored and insured professionally. So I wouldn't worry about that. But going back to your question, mining companies, I think there's a variety of things to think about, all of which I kind of cover. But the first is, are they a producer or are they an explorer? Really simple question. If they're a producer, they're actually producing the gold and benefiting from higher gold price, but their costs have probably gone up a bit as well. If they're an explorer, they're not producing, but they're looking for it. And that's a kind of fundamental question that investors should ask. Producers, with the gold price going up, share price can still go up dramatically, but explorers, much higher risk, but the returns can literally be life changing. I picked one, and because of it, my daughter's being privately educated. I've never had to pay for holiday because I always go to. I put a mate into it as well, and he made so much money. I use his ski lodge, I use his holiday home, all that kind of thing. It's kind of like if you get it right, you can make an awful lot of money. But the way I kind of try and explain it to people is really a fancy football team, because I kind of say you want to have a goalkeeper, which is a massive multinational, defenders, which are sort of large mining companies, midfielders are smaller ones or ones new to production, and then your forwards are your explorers. And what I say to them is, look, what you want to do is you want your team to win, and depending on where you are in life and what your appetite for risk is, you could have more forwards or more defenders or more midfielders, whatever you want. But the point is that the team needs to win. And what I'd say is, at the end at the Premier League, you probably know some of the players from last year. But if I said to you, who won the Premier League 10 years ago, you may go, oh yeah, I know that. I think it was Arsenal, Man U, or whatever it was. But if I said, okay, name the team, you wouldn't have a clue, and you might get one, but that would probably be more kind of guesswork than anything else. And it's the same with a portfolio. You have lots of different companies in it, and don't expect them all to perform well, because they won't. But the whole idea is, if you've built it properly, then your overall return, the team should win the game, the portfolio should win. And there's no point having a portfolio with, let's say, Messi in, but the rest of the players are rubbish, and you end up losing money. So yeah, going back to choosing your investments, yeah, production or exploration, but I'd then say diversification is important, because you don't want to have it all your money in one particular company or two particular companies, because don't get me wrong, they could do really well, but you'll be reaching for the gin bottle if something happens in the market or in that country and the share price capitulates. Whereas if you've got a broad spread and you've got some physical, you've perhaps got a fund, then you've got a lot more balance to your investing.
Okay, so if we start off with the the goalkeepers, then I guess you'd say like blue chip miners. How would we go about looking for a good candidate?
Well, again, this is what I kind of teach people. But I mean, I've got a book called The Beginner's Guide to Investing in Gold, where I kind of show you what the kind of criteria you should look for. Generally these are very large companies, so I'd say over 15 billion market value. But then there's other criteria you should look for as well, which I cover both in the book and the course I offer. And then but yeah, you're looking at really a massive company that is, yes, the shares could go up 50%. If you're lucky, get a double, but you really got them there for the fact you've got massive exposure to lots of different commodities as well. They'll definitely be paying a dividend, so you get some income from them, and yeah, you've got a very large company, which which is ultimately a good thing.
And then the other two divisions, shall we say, the midfielders and the strikers. What
Well,
would
yeah,
you look for
you've
with
got
those companies?
just between the goalkeeper and midfielder, you've got your defenders. So you've got your uh, they're smaller than multinationals, but they're larger than your midfielders. So they're kind of established producers. Your
Mm.
midfielders tend to be niche production, or perhaps they've only got one asset, so they're particularly exposed to a certain country. So I view them as higher risk. And then your forwards are your out and out explorers, and uh, they're the ones that can give you life changing returns, but they're highest risk. And I view them more as speculation than investment. So it's nice to have a bit of money in them, but let's say you've got a portfolio, I'd put the lion's share of it into the other positions and just have a little bit in your forwards. So each day you get up, you've got potential for some life changing returns.
So, are there any sort of criteria in particular that sort of jump out at you that when you are looking for a gold mining company that that sort of telltale signs that you use?
Yeah, I mean, size is one thing. Jurisdiction is another. Um, I like to be diversified from lots of different angles. So not only do I like to have lots of different companies, but in different countries. So you've got diversification from jurisdiction. So let's say something happened in Australia. Whilst you'd expect the prices of the Australian uh, producers to uh, capitulate, you'll probably find the ones in North America go through the roof. So there's a kind of a slight balancing act. Um, but yeah, I think you want to be diversified from a country point of view. You want to be diversified. That naturally gives you diversification from a currency point of view, which I think is important as well. Um, and even though I like to be predominantly gold, I like to have a few other commodities that I'm exposed to as well in the portfolio. Silver, copper, uranium, things like that. Um, and yeah, I think the other thing about these miners is they're incredibly liquid. Especially these big companies. You could sell the shares today. I think settlement is T3 or T4. I don't know what it is, but basically, as soon as your broker settled it, you've got the cash, and I think that's very important to people. And it's not like property where you could, it'll take you 2 or 3 months to sell it, and the deal could fall through, and you have to pay surveyors fees and a whole load of fees as part of the process. This is a much quicker, cleaner way of entering and exiting a market.
I think we should just explain a little bit about the mechanics of why gold mining companies can be quite lucrative investments, because you've got like they call it operational gearing, don't they, that comes into play where you've got a relatively fixed cost base, but then if the gold price increases, you can get profits going up by multiples in quite short order through an increase in the gold price. So can you kind of explain that mechanism, how that works, and then how we can see gold mining companies actually outperforming the gold price?
Yeah, no, absolutely. I mean, it's uh, you pretty much what you said was spot on. Your fixed costs, um, they are likely to move. Inflation is likely to make labour costs, energy costs more expensive. But if the gold price really takes off, um, the gold price could, let's say, well, in theory, double. It's unlikely your costs will double. Your costs will probably go up, I don't know, 20, 30%, whatever it is. But if you've got one thing, if you've got your gold doubling and your cost going up 20%, your margin expands. And as your margin expands, the company becomes a lot more profitable and therefore throws off a lot more cash. So I think that is one reason why you should like these companies. And I think the other thing is there's a lag between the market knowing they're profitable and they're actually being profitable, because the gold price, that changes daily, whereas companies only report quarterly. So, and quite a lot of them have got what's known as hedging. So they've got a locked-in gold price, so they're not benefiting from the increase in the price. And so when they put out results, this is particularly the midfielders, because if you've just spent 200 million building a mine and processing plant or whatever it is, you've got to pay it back, and you don't want the risk of the gold price crashing. So what they tend to do is lock it in and hedge it, so they know that they've got this money coming in, so they know they're going to be able to pay back their creditors. And but it takes a while between the gold price going up and some of these companies to sort of show the benefit of that. And I think that's you've seen equities start to move recently, but in theory they could move a lot more. And I think the other point I'd add to that is physical gold, you can't leverage against it. But if you're talking about a company, these companies, because they're generating cash, you tend to find there's leverage within the company, and then as they pay a dividend, that means that there's an income for the investor, and therefore if the investor wants to get a bit of leverage, they can look at getting some leverage. But that's why I think it's important to have several companies, because if a company stops paying a dividend, you're in a spot of bother. But if you've got several companies and they're all improving their cash flow because the gold price is outperforming the costs, then I think it could be quite exciting for investors.
What about valuations at the moment then? Because I was at a lunch the other day, and a few fund managers were talking about the allocation to gold mining companies is actually absolutely minuscule in terms of the sector allocation in portfolios. So presumably the gold bull market, the bull market in gold equities could have quite a long way to run, because the allocation at the moment is so tiny. And a lot of these managers were basically saying that they'd not got any allocation to gold whatsoever. Can you put the valuation in kind of like a historic perspective for gold miners? Just give us some kind of perspective on the whole thing.
Yeah, look, I mean, one of the things that is going to really change the value is the gold price, because certain mining is unprofitable if the gold price is below certain levels, because you've got a cost, and let's say you've got lots of gold, but you've got to drill through a lot of barren rock to get to it. The cost of that drilling could be a lot of money, and if the gold price has gone down, then it's not really worth going through the pain of all that drilling to get to that gold, because even when you get to it, the gold price has gone down, and it's not going to be massively profitable to extract it. But if the gold price goes up, which it has done, then the gold that was, let's say, previously worthless, for want of a better term, suddenly is not worthless, and it's worth a lot of money. And I think what you tend to find with some of these companies is they haven't explored in all directions. And what they may find is, generally, I don't know, the mine life 7-10 years is fairly common. But when they're mining is a sort of the ultimate way of exploring in a way, because you've drilled an area, so you've got a high degree of confidence that there's gold there. Now, when you mine, you've got a high degree of confidence that the gold that you expect is there, but there could be other gold as well. And if there is, and this does happen, it can take your mine life from 10 years to 15 years. And, you think about that from a valuation perspective, you've got another 5 years of cash flow that wasn't in the previous valuation. So your valuation shoots up.
So, how long do you think this market has got to run then? Do you think we're in the kind of like the early innings at the moment, or we're in the middle, or where would you say we are?
Okay, well, look, I heard this fact last week. And it's silver, but I think it's still relevant. The previous silver high was 2011, which was around $50. And I know it's now about 52-ish, but 2011, so that's 14 years ago. Now you think about what you could buy with $50 14 years ago, and compare that to today. So even though people are like, "Oh, silver's an all-time high," I don't think it's even on the launch pad, let alone all-time high. And gold is, given all the issues I mentioned about uncertainty and things like that, I think the price will go up potentially a lot from where it is at the moment until some of these things are resolved. And so,
by some of these things, you mean kind of like the situation with the financial system, monetary
yeah,
policy.
exactly. I mean, I think there's a lot of concerns about the financial system, interest rates, inflation.
There's no sort of prospect of that happening anytime soon, is there really?
Well,
given the scale of the problems.
That's my point, and therefore I think gold will become increasingly important as an asset class, and we need to remember you can't print it, and so I think that there will be a move towards gold. What will happen to the price is anyone's guess, but I think all I'd say is there'll be a move towards it, and that is likely to increase rather than decrease the price. And going back to what you mentioned earlier, a lot of fund managers have got little to no allocation to it. A lot of people have got little to no allocation of it. So even a small move from fund managers or people towards gold, which I think is what we're starting to get now, will send the price up. And I know people who work at bullion dealers and things like that, and they are literally rushed off their feet at the moment. They're just not set up for the kind of demand that they're getting. And I think if it's only a few weeks, then that'll be fine. But if this continues, in theory, you could run out of gold, and it's kind of incomprehensible to think that. But because you can't print it, there's only so much of it you can get, and if you've got the central banks clamoring for it and institutions clamoring for it and the general public clamoring for it, logically, it can't go on forever.
So from the perspective of an investor who is looking to get an allocation to this sector, it can be quite daunting, can't it? Because there's so much terminology thrown around that unless you're a geologist, you don't really understand what's being talked about, really. So what's a good place to start in your view in terms of educating yourself about this sector and about all the sort of jargon that's used, so that you can actually understand what's going on?
Yeah, I mean, what I suggest people do initially, obviously I'm talking my own book here, but on my website, I've actually got a blog with the terminology. It's all free, and you can actually just go to that www.goldprogram.co.uk and find out what the terminology is. And if you're new to the market, I'd certainly suggest getting a bullion account, and a lot depends on how long you're looking to invest for. If you're looking to invest for less than a year, then you perhaps something like an ETF or something, which is pretty low cost. If you're looking for a longer term investment, then I'd look at physical gold. And a lot depends on how much money you've got, really. But I mean, I would suggest building from the back in terms of football parlance. So get some physical, then get a fund, then get a goalkeeper, then get defenders, then get midfielders, and if you've got some money left, get your forwards. But don't. A lot of people, I was talking to someone last night from Forbes, and I said, what are you looking for? They said, I want to make as much money as possible. And you're like, I kind of get that, and that's the mentality of a lot of people. And most people go out and they buy the forwards, and the forwards can take years because bear in mind they haven't actually found anything yet, and so it can take several years for them to get into production, and by that time the gold price could have tanked. And so what you want is a company that's producing it now, and that's the way you start off. And then as you go through the system, then you get your your forwards and things like that. But I would suggest for a newbie, think about how long you want to invest for. If it's less than a year, I'd say something like an ETF or something like that is probably a good thing to look at. And if you're looking for a longer term investment, then I'd probably look at getting some physical and perhaps a fund. And again, a lot depends on how much you want to put in the sector as well, because if you're looking at less than 10 grand, then the whole idea of buying companies is you buy 12, 13 companies, and you probably want to have at least 800 quid to £1,000 in a company because of the cost of buying, selling and holding. So you need a certain amount of money to do it. But if you're just thinking about sticking a small amount of money in, less than, let's say, 5,000, then I would look at physical or ETFs depending on your investment horizon.
It's that old adage about learning to walk before you can run, I guess.
Yeah, exactly. And it's you got to start. You've got to start with your first step, and I think your first step should be physical gold, or an ETF, or both. A lot depends on. There may be some people who go, well, I don't know if I want the money this year or next year, and I've got £2,000. So you go, okay, well, why don't you put £1,000 in physical, £1,000 in ETF, and so it's really up to. I think this is the other thing. The thing I try and teach people is you've got to build a portfolio for you that suits you, and that's sort of different to a fund, because a fund suits the fund manager, and it suits the strategy of the fund, and that may not be the same strategy that you have, and especially if you want income and the fund doesn't pay a dividend, you're kind of like, well, where's my income? And I've got all these companies, so you really need to work out what you want to achieve, and work that out first, and then go and invest accordingly, rather than make the investments and go, what does this give me? And that's the wrong way to invest. You've got to start knowing what you want to achieve, and then build a portfolio accordingly.
Brilliant, thank you, Simon. And how do our listeners learn more about you and what your program, your gold program?
If they go to www.goldprogram.co.uk, there's a lot of free information on there, all these blogs and stuff. So I suggest they have a look at those first. There's a book that I've written, The Beginner's Guide to Investing in Gold, which has got a couple of freebies with it. One is where the big funds are investing, so you can see where the big money is going, and the other is my 6 pillars of investing, so the 6 things I think are important when making any investment. So you get those with the book, and I'd say read the book and look at all the free stuff on the website. As you say, run before you can walk. Walk before you can run, sorry. And but then at that point, if you want to get into buying gold, and on the website there's some people you can buy gold from, then by all means join the gold program. But it really depends on where you are in the journey.
Excellent. Well, it's certainly very exciting times to be in the gold space at the moment, and Yeah, well, we'll see what happens. Thanks again to Simon for his time today. If you enjoyed the show, please do give us a follow and a like, and we'll see you next time.